Here's how you raise money from investors to buy your small business. First off, I'm a professional investor. I invest in everything out there: stocks, bonds, commodities, real estate, everything. But nothing out there compares to the returns that you can get from investing in this small business space. Now, it is the riskiest of all those categories, but you are well compensated for the risk that you take. So finding investors isn't as hard as you might think. For the deals that we do where investors are involved, we typically target a 25 to 50% internal rate of return, or IRR, to the investors. And compare that to really anything else out there, it really blows it away. So as long as you can gather your information together and present it in a way that shows that you should be the buyer and that this is a good idea, it's not that hard. You show somebody 25, 50% returns, they're in. But you do need to show that you have the ability to run this business. So you're gonna wanna show your background, why you're a good fit for this business. I really think you shouldn't be raising money for something you plan to own passively. You should be planning to go run that business, and it should fit well within your skill set if you're bringing on investors. And on a side note, I know a lot of people like that phrase, other people's money. I'll tell you what, I will never work with anyone that uses that phrase. Like, taking money from investors is something you should take very seriously. You should act as a fiduciary. Just calling it other people's money, or OPM, makes you sound like a jackass. So the way that we typically structure deals is it's a 2-for-1. So meaning for every 1% of the purchase price an investor puts in, they get 2% of equity. So for example, if you have a business that requires a 5% down payment and they're making 100% of the down payment, so that's 5%, they're gonna end up owning 10% of the business. So you double their percentage. So really they put in 100% of the equity, but then they end up owning 10% of the business. And of course, the other 95% is gonna come through the form of the loan, through likely an SBA-backed loan. So that's where you, as the operator, the person putting this together, gets to essentially keep the majority of the equity in the business. Now, some people structure their deals where the investors get a preferred return, so they get paid first, say they get like a 12% return. We don't do that in our deals just because we just really value simplicity. We think keeping things simplest structure as possible is really the best way to go. So it's just straight equity. There is a preference in liquidation to the investors, that they get their money back first, just so that you can prevent someone, raising money and then selling it the next day and just collecting the check. And so there is a preferred return there, but not in the income. And we just do that because there's just so much more demand from people to invest in the space than there are actually deals that need investors. One, we want to keep it simple, and two, we just don't see a reason that we need to give that preference. And before anybody asks, we cannot raise money for third parties. For regulatory reasons, we only raise funds for companies that we are already partners in, that we are already invested in. We cannot do it for unrelated third parties. But we're happy to share our experiences so that you can do it yourself. If you have any questions, leave them in the comments.